Okay, we will start in a minute. The system is just allowing everyone in, so we will start within a minute. Thank you. Okay, it looks like the system has caught up and everyone who was waiting is in, so a great number of attendees this evening. My name is Gary Gallant from TMFD Financial. Carla Fernandez is on here as well, managing technology this evening, and Chris Molloy is our guest speaker, who we'll get to in a moment. But welcome to number 2 of 4 in the TMFD Academy webinar series for the fall on Are You Fit to Retire? Are you fit to retire? And our speaker this evening is familiar to many of you, Chris Molloy, who's a Senior Vice President of Advisory Services. Chris has been with TMFD Financial for over a quarter of a century, using and growing his expertise to help dentists. And that's a quarter of a century after a university degree and after working in insurance somewhere else for a short while as well. So congratulations, Chris. For this evening, there will be some polls that will be appearing. Please answer those. It helps us with the CE credit verification that Carla is managing. And as questions come to you during Chris's talk, please put them in the Q&A. Please put them in the Q&A. So on your screen, you should have a Q&A button. Touch the Q&A button and enter your question there. And Chris may have an opportunity to answer it while he's presenting, or he will get to it at the end otherwise. This evening's sponsor is TMFD Financial. So we're sponsoring this ourselves this evening, and we're very pleased to be able to do that and to have you join. And so now we will turn it over to Chris. And at the end, Carla will talk about the CE credits, and we'll have a couple of other points to make as well. But over to Chris for now. Thank you, Chris.
Great, Gary, and thank you very much. My name is Chris Molloy, and on behalf of TMFD Dental Academy, I want to thank you all for attending this evening for our presentation, Are You Fit to Retire? I am just going to try to share my screen so you can all see the presentation. But I am pleased to see so many people here this evening. I think it shows great interest in the financial planning and in retirement readiness. The other thing for this presentation, I'm going to be discussing many of the factors that go into what constitutes the financial independence target, and we'll be going through a couple of case studies. So I just want to let my team know that I'd like to be able to get the presentation up on the screen. I have no screen sharing, Carla.
Can you try now?
That should work.
There we go.
Perfect. Thank you. So the impetus for our discussion this evening was the result of our latest book, The Financially Independent Dentist. The purpose of the book was to help clients to develop an integrated financial plan and ensure that all financial decisions are made with one goal in mind, and that's to ultimately reach financial independence faster. At TMFD, we've created the Financial Independence Framework for achieving financial success. And it starts with 5 simple questions about yourself and your practice. So the 5 questions are, first of all, what is my fit number? How can I make my practice work for me? How can I align my practice with my life? How can I grow my wealth? And how can I protect what I've built? So with these 5 questions, we've put together a framework to achieve peace of mind that comes with knowing that every financial decision brings you closer to your dreams for you and your family. So tonight we'll be focusing on the first of those questions, what is my fit number, which I will explain shortly. I also want to point out that all of our participants tonight will receive a complimentary copy of the book. It's currently in print and will be available soon. And you can get more information from our website or follow us on social media. I also want to mention we're going to have a couple of questions as we go along just to keep people in tune with where we're at. So there we go. Now, briefly, I just wanted to take a moment to introduce TMFD Financial for those that may not know us, here's what I wanted to first start with our mission statement, which is we enrich the lives of dentists and their families by providing a comprehensive and integrated set of accounting, financial planning, and consulting services through one point of contact. This is what we tend to see when clients come to us. Most dentists develop a set of professional relationships as they progress through their career. So they'll have an accountant, a banker, an investment advisor, insurance advisor, corporate lawyer, a practice consultant, and an estate lawyer. And together, these individuals do a fine job on their own. But the dentist at the end of the day is left in the middle to try to coordinate and interact with all of these professionals, which sometimes can lead to misinformation or just simply more effort on behalf of the dentist. So TMFD Financial is different because we work closely with each of the dentist professionals. We sit on the same side of the table, and we make sure that we coordinate these activities together. We like to say that it's not about interfacing with all these professionals. It's about the integration that's most important. So just to be clear, I wanted to mention the services that we do offer our clients. So clearly the tax and accounting piece, but it also includes investments through our affiliation with Asante Wealth Management. We also offer insurance products, life and disability, and some coaching services as the need arises. For other aspects of someone's financial situation, such as law, whether it's a corporate lawyer or an estate lawyer, we will make introductions to some preferred contacts we have in the industry, or we can work with existing professionals. At the end of the day, our objective is simply to simplify the lives of dentists and ensure that they meet their financial goals. So now I want to get into the presentation and talk a little bit about why we're here today. I want to take you on a journey of what financial independence might look like for you. So for some, it might include more travel or possibly more leisure activities like golf. Could include spending more time with family, or possibly pursuing some charitable pursuits. And for those that achieve financial independence, it might mean slowing down and still doing dentistry part-time. And of course, throughout it all, we need to ensure that we have good health to enjoy, and of course, be mindful of the future costs of healthcare. Regardless of your vision, it's important to have a game plan for how you will spend your time, because in many ways, it will also define how you spend your money. A solid financial plan will provide the confidence and peace of mind that you need to achieve these goals. So I want to start by asking, what is financial independence? And I think there's some key takeaways from this concept. Clearly, the first one is the ability to control your time. It's really about how you live your life, or how you can wake up each day and do what you want, whether that's the ability to enjoy those other things I talked about, whether it's travel or leisure or family or part-time work, whatever your goals may be. Another interesting aspect is the ability not to think about money anymore, which I think is actually an interesting twist on how we view money, because being financially independent is kind of like the air we breathe. It's so abundant that we don't even need to think about it anymore, even though clearly it's a critical part of our lives. And the last point I want to mention is a career that allows for intellectual honesty, which is a very interesting point, but I think what it means is being able to say to patients and to colleagues that perhaps, I just don't know the answer, let me get back to you, or perhaps this procedure isn't necessary right away. It lets you be open and honest about about the things in your profession and your career, about decision making and in your life. So I find those are some key takeaways for what financial independence means. Now, the key question, what is my FIT number? Now, we call this the financial independence target. And that really is a goal that you set for yourself for savings and investments that represents financial independence for you and your family. Now, some of you might remember years ago, there was a TV on commercial where people were walking around with a number under their arms. And that really was for them, their individual savings target. Now, one of the other comments here is about replacing 100% of your lifestyle expenses during retirement. I really think that's key because I don't know anybody that wants to retire and spend only 70% of their pre-retirement income. So I think that whole notion needs to be revisited, which is why when we're doing financial plans for clients, we focus on maintaining their existing lifestyle so they don't have to make changes or cut back. And the final point is that the FIT number is unique for everyone. You know, it's so true that everyone needs a personalized financial plan to take into account their unique situation. And I must say that tax planning is a really big component of that equation. So I'll give you an example. I mean, there's a really big difference between someone that has all taxable investments like RSPs or money trapped inside of a corporation versus someone that has money that's not already after tax. So monies that are in an open account or in a tax-free savings account. So tax planning is a big part of these financial plans as well. But you know, to sum it all up, once you know your FIT number, you'll have the confidence of achieving financial independence. I want to share with you a video. This video is about 2 minutes long, and you may know the names Rob Carrick and David Chilton. Rob Carrick writes for the Globe and Mail, and David Chilton, of course, is the author of The Wealthy Barber. And they're going to be talking a little bit about retirement readiness.
Dave, let's talk about the nation's retirement readiness. There seems to be two streams out there. One group saying everything's fine, and another saying that there's a crisis here. We're not saving nearly enough. How do you see things?
They're both right. I mean, there are a lot of people who are in very good shape, but there are a lot of people who are battling a crisis. Look at Rob. I see more financial plans than anybody. I really do. People won't stop sending them to me. And when you look at them and go through them carefully, if people have access to a defined benefit pension plan, often too, by the way, because teachers marry teachers, government workers often marry government workers, they're fine. They're in very good shape in many instances. They also tend, for complex reasons, to be better savers. They didn't need to be because they had the pensions, but they are. But if you have a family where there's no defined benefit pension plans whatsoever, and you've got this low return environment, and you do the math in their situations, a disproportionate number of them are in very dangerous shape going forward. So they're both right. It depends on where you come from. Too many economists now are getting into personal financial planning and using aggregate statistics to draw all their conclusions. We need these same economists to sit down with 50 families from the 30th percentile of income, 50 families from the 50th percentile, and 50 from the 70th, and take that 150 family data point, look at it all, and they will come away and go, whoops, we do have a bit of a problem, more than we thought.
All right, so let's segment things. Let's not worry about the people with the DB pension plans. They're fine. If you don't have a pension plan, what's your best advice to those people in terms of their retirement savings?
You have to save a lot of money. I'm sorry, but you really do. In fact, with a low return environment, you have to save even more than the Wealthy Barber and the other writers, the Rob Carricks of the world, used to teach. It's not easy. Things are expensive. Real estate being this expensive, by the way, is more of a negative for society than positive. I've said that for years. Everybody wants prices rising, rising, rising. I'm telling you, at the end of the day, it's better for the economy when housing is more affordable and money on a cash flow basis can be dedicated to other purposes.
All right, but the general message is, however much you're saving, you probably need to do more.
Yeah, in most people's cases, it's absolutely true. And not dramatically more in all cases, but somewhat more in most instances. The problem is there's no blanket answers. You really do have to look at the individual situations. It's important, as always, to try to marry somebody wealthy.
Okay, thanks, Dave.
All right, thank you.
Yes, well, David Chilton is known for a lot of wise words, but if only it was that easy. Now, for most of us, we start with a good education and some student debt and build wealth gradually throughout our careers. But you know, this video reminds us of the importance of saving for retirement, and especially for those without a pension, like so many dentists. It also highlights the importance of having a financial plan so that you can develop a roadmap towards financial independence and your FIT number. And that knowledge brings peace of mind, which is truly valuable. So I want to take a moment to talk about the components of a financial plan that we take into consideration. So you see here, we've got net worth, cash flow, the corporate structure, tax planning, estate, and insurance. So starting with net worth, this is a great measure of your financial progress since it places a value on your assets, including your practice, your home, and your savings. It also includes any debt, which must be included in any comprehensive financial plan. Net worth is important because we focus on the assets you own, which provides an income during retirement, which, by the way, typically does not include your home or your recreational property. With regards to cash flow, what we're focused here on is personal lifestyle expenses. This includes the cost to maintain your home, family needs, automobiles, insurance, and then discretionary spending such as travel and dining out. For corporate structure, we look at things like the shareholders, the tax planning opportunities that exist, such as the lifetime capital gains exemption, which offers great tax advantages. But that's only part of the picture when it comes to tax planning, because we can look at other tax strategies, such as an individual pension plan, which I'll mention again later this evening. They can include pension splitting during retirement, and also structuring sources of retirement income to minimize tax over one's lifetime. With regards to estate and insurance, we'll touch on the importance of wills and powers of attorney to identify current insurance policies in place. There can be probate planning, ways to reduce probate fees. We'll look at beneficiary designations and secondary wills, all which help make a prudent estate plan. Even though all these components tend to overlap, they do need to talk to each other to ensure that we develop a solid and robust financial plan. There's a number of factors that affect retirement income planning, which I will take a moment to talk about. So life expectancy, investment returns, inflation, taxation, and spending patterns. Now, with regards to life expectancy, I think we're all aware that clearly life expectancies are getting longer and longer. I mean, they've changed dramatically over the last century. But with the current statistics, from birth, most people will live into their mid-80s these days. If you make it to age 65, life expectancy is late 80s. And then when we deal with spouses, a couple, the chances of one spouse living beyond 90 is very high. And so we must plan for many years of retirement in the financial plans that we do. With regards to investment returns, well, as we all know, these days it's a very low interest rate environment. 1% is what you might be able to get on a GIC. But with the planning projections that we use, we tend to focus on around 5% a year, which can reflect a balanced portfolio. Now, that's not a substantially high number, but I think it's a prudent number given the return environment that we're in these days. It allows us to be conservative in our planning assumptions, and if we can earn higher returns, then it just provides even more confidence in the financial plan. Now, inflation, as you know, erodes the purchasing power over time, and that can accumulate greatly. The government of Canada targets inflation between 1% and 3%, but as you may have read the highlights or the headlines recently, inflation has spiked as we've come out of the COVID recession. They will likely normalize again between that 1% to 3% range, but I suspect it will be closer to the higher end in the foreseeable future. But even at these modest rates of inflation, the cost of living can double over one's lifetime when you think about property tax, the cost of food, and other expenses in life. So we definitely have to factor that into calculating the FIT number. Taxation also is a key focus, as I mentioned before, because what we're trying to do is minimize tax throughout one's retirement years. And as you know, we have a tiered tax system, which means you pay more tax when our incomes are higher. So of course, the objective for us when we do tax planning is to try and smooth one's income and tax burden year over year to avoid the spikes. Now, this last item, spending patterns, is by far, in my mind, the biggest factor in determining one's FIT number. Consider, for example, someone who their lifestyle spending is, say, $150,000 per year. I think it's reasonable to expect that they would need twice as much in savings as someone who's going to spend $75,000 a year. Of course, that would need to be adjusted for any pensions. But the point is that anticipated spending patterns have a greater impact than any of these other factors that we've discussed. And that's why we take a deeper dive with clients and spend so much time reviewing their current household expenses and their projected expenses so that we can factor that into the retirement calculations. In the book, we talk about something called the sustainable withdrawal rate. And some of you may be familiar with this concept called the 4% withdrawal rule. Now, it's a starting point in my mind. There's a lot of factors and assumptions that go into the 4% rule. It was developed years ago by an economist, and it made the assumptions that this was someone who was 65, who had about 25 years of retirement, had fairly steady returns on their portfolio, and inflation and steady tax rates. And this would allow for index or inflation protected income throughout their lifetime. Now, I have to bear in mind that this was developed at a time when interest rates and returns were a little higher than today. But this 4% number is a starting point. So for example, if there was $1 million in a portfolio, it could provide $40,000 per year throughout one's lifetime. But if someone starts earlier to retire or starts later, or we use different investment assumptions, we really can't rely only on the 4% rule, which is why it's so important to have a personalized financial plan to determine each person's unique fit number. Before we get into the case study, I wanted to take a moment to talk about the different sources of retirement income that most of us will receive. You know, clearly we know about Canada Pension Plan and Old Age Security. These programs will help provide for a portion of our income, but they won't provide for a big portion. And it's important to get a better understanding of that. And I'll spend a moment on it in a minute. For most dentists, they do not have the benefit of a traditional pension plan, unless perhaps their spouse is married to a teacher or a government worker, and we can factor that into their fit number. However, I will mention later that dentists can establish a pension plan for themselves called an individual pension plan, which does offer some enhanced tax credits. Personal savings will end up comprising a big component of a dentist's retirement income, whether it comes from their RSPs, tax-free savings accounts, non-registered accounts, or money that is left behind in a corporation. And no doubt, often the biggest component is the proceeds from a practice sale. You know, when doing a financial plan or determining the fit number, one of the key objectives is to develop or craft a plan for drawing upon these various sources of income to maximize one's lifetime income and do it in a tax efficient manner. I also want to point out again that when we're doing these projections, we really try to avoid using any of the equity in the principal residence or any recreational properties, simply because those are part of your lifestyle. When we look at the cash flow and the expenses of the family, we take that into account so that, again, you can continue to enjoy the lifestyle that you've been accustomed to. And the equity that builds up in those properties can be used as a backup if ever needed. Just take a moment to briefly explain about Canada Pension Plan and OAS. They are two separate programs. CPP normally starts at 65, but it is available as early as 60 or as late as age 70. And under the current format, the maximum benefit at age 65 is $14,400. Now, if you take it early, there is a reduction, and it's a permanent reduction. And if you take it later, then it's a permanent enhancement. So the choice is individual, but a lot of the times I try to suggest that people at least take it at 65, and then we could look at other options after that. A lot of people have concerns about the viability of CPP in the long run, but the reality is that we all of us that are working and receiving salary, I might point out, do contribute towards Canada Pension Plan. And that program is worth about $500 billion. So there is great expectation that that program will be around for an awfully long time for everyone to participate. Now, old age security starts at as early as age 65, not sooner, and could be deferred as late as age 70. So again, like CPP, if you do defer, there is an enhancement and it's a permanent one for your lifetime. The maximum benefit right now is about $7,500 per year. The difference is that OAS is subject to clawback for individuals whose income exceed $80,000. And the difference is because we don't contribute to OAS, we simply earn it for being a resident. I mean, the benefit is maximized after 40 years of residency. But as I say, it's for those individuals that have incomes below 80,000, and it's fully clawed back by the time income hits about 130. So I think what it does is it highlights the importance of structuring retirement income in the most tax efficient way possible. Now, overall, these government pensions could provide about $20,000 per individual or $40,000 per family. So while this is significant, the government pensions are simply a nice supplement to the main sources of retirement income, which come from savings and the practice proceeds. Okay, we're going to take our first quiz here. And the question is, which of these programs are available up to age 70? CPP, OAS, CPP and OAS, or none of the above. So if you see, there should be a question that appears on your screen now, and you can make your selections. We'll give a couple seconds for people to respond. Carla, do we have the results of that?
We have some results, yes.
Okay.
Yeah. We have 24 so far. I'll just give it another few moments here and then we'll end the poll.
All right, well, hopefully the question isn't too difficult.
Okay.
All right. Yes, so the correct answer is C. Both of these programs can be taken up to age 70. And for those that defer past 65, they do receive a pretty substantial enhancement. All right. Let's move on now to our first case study. This is a situation which we find quite often. We have dentist and spouse, both age 50. The dentist is a practice owner, incorporated, and the spouse is the office manager. And in this case, they have a desire to retire at age 55. So we have 5 years ahead to plan for. So if you recall, one of the key components of a financial plan is starting with net worth. This client has a net worth of 4.6 million. The first two components here are the dental practice and the building. They comprise 2.5 million. They have their home, 800,000. This, by the way, is not a home in Toronto, in case you were wondering. Then the other 3 or 4 savings are corporate investments, the RSP, an individual pension plan, and TFSA. So when we focus on these and break it down a little bit more, retirement income will come only from those sources of liquidity. So currently, that's the last 4 that are in investment assets. But in time, it will include the dental practice and the building. Currently, that totals 3.8 million, right? So it excludes the principal residence. These clients plan to retire in 5 years and will continue to save until that time. And I'll share those details in a moment. Taking a look at the corporate structure, again, is a really key component of a financial plan, because to the extent possible, we'd like for dentists to be able to use the lifetime capital gains exemption. think most of you are familiar with what that is. It's advantageous because it allows the sale of shares of a dental practice, and the first $900,000 of the proceeds are tax-free per person. So when there are two spouses, it could be up to 1.8 million. However, in order to benefit from the gains exemption, the company must qualify and satisfy certain tests. So one of the first tests here is that the DPC, Dentistry Professional Corp, must have less than 10% of its assets actively engaged in the business. Investments are considered passive assets, not active, and therefore, if the practice was being sold today, it would not qualify for the gains exemption. The DPC must be purified prior to sale in order to qualify. Now, we do accomplish that for our clients by setting up a sister company or an associate DPC to receive the investments and to aid in the ongoing purification of future profits. But I must let you know, of course, that it's not simply a matter of setting up another company and then transferring money across. There are a number of legal and accounting transactions that have to be done in order to set that up properly. Now, just a little plug for my colleague, Steve Farinato. He will be hosting a webinar next month on the financial issues when preparing to sell your practice. So if you'd like to learn more about what's involved to prepare and qualify for the gains exemption, then I invite you to join us at that time. But as you can see, this element of the financial plan can save hundreds of thousands of dollars. For this couple, if they could fully utilize it, it could potentially save up to $450,000. It's about $225,000 per individual. So pretty substantial. Now, one of the things that we do for our clients when we do an annual review of their accounting is we do a breakdown of their dental practice. And we compare the income and the expenses to benchmarks so that we can see how the practice is performing, maybe identify some opportunities for improvement or identify areas that are going very well. And of course, if we can improve the cash flow in a dental practice, we can improve its long-term value. So with this practice, we have revenue of 1.1 million and expenses of 605, which is about 55% overhead, pretty typical for a practice of this size. We also focus on how the doctor and the family compensates themselves. So in this case, we have the doctor taking salary of 180, the spouse of 60,000, and the IPP, or individual pension plan, is also a corporate expense. So that leaves the profit in the company of 207,000, and we back out the tax. We add back the amortization because it's just an accounting item. It doesn't go through the bank account. So as you can see here, this practice generates cash flow each year of $192,000. That represents the investable amount that can be saved towards future retirement and financial independence. On the right-hand side of the schedule here, as I mentioned, we show a breakdown of the various expenses and can compare it to see where there's opportunities. So it's a good value added for our accounting clients. Now, another opportunity to save tax is provided through an individual pension plan. An IPP is attractive because it actually allows greater contributions than an RSP allows, at least for recipients that are over the age of 45 for sure. It's usually break even around 40. And as you've seen, it's a corporate deduction instead of a personal deduction. So effectively, an IPP replaces future RSP contributions. Now, just like an RSP, a pension plan is based on salary, not dividends. So it's very important to make that distinction, because if we're going to participate in a pension, we must pay ourselves salary. And as I say, because the pension contributions are greater than an RSP, we can accumulate 50% or more by age 65. And then at retirement, of course, we do control those assets. So Plan holders have the ability to transfer it to a LIF, which is very much like a RIF or an RSP account, or it can be used to purchase a life annuity and fulfill the truest sense of what a pension is all about, to provide lifetime income. So what I have here is a graph just to illustrate and compare how an RSP would grow versus an IPP. In this particular case study, there are 2 members to this plan. So as you can see, the accumulation is quite significant over time. Now, I must let you know that an IPP, it's a little bit more complexity than an RSP. It must be registered with the government, and we must get input from an actuarial firm for the calculations. So there are certainly some costs to set up and maintain, but as discussed, there are many advantages. And as a corporate deduction, it's a helpful tool to remove excess profits from the corporation and keep it purified as we go along. And we also focus on the lifestyle spending for the family. As we said, right, what does it take to maintain the home, other household and family expenses, automobiles, maybe life insurance, and of course, discretionary spending or expenses of lifestyle, such as vacations and recreation. As I said earlier, this is really, to me, the most crucial part of the planning process, since spending patterns have a significant impact on our calculation of the FIT number. I think it's important to have an honest discussion about the true expenses of the family. It's not, for us, it's not about being judgmental. This is really about ensuring that we plan properly, using realistic expectations to ensure that our planning assumptions do not fall short. I mean, no one's going back to work at age 85 to become a Walmart greeter. So we want to ensure that we have enough savings in place from day one. Now, in this scenario, the client is spending $150,000 a year. And that's important for the projections. The other thing that we do at this stage is we adjust for current expenses versus anticipated expenses. At this time, if you're still working and in practice, no doubt you have many of your expenses paid through the corporation, such as automobile, cell phone, even meals. But the reality is, after a sale of a practice occurs, there isn't the opportunity to do that any longer. All expenses become personal. So we have to adjust these expenses up or down accordingly. So I'm going to now focus on the retirement projections for this client or this couple. As I mentioned, they will continue to save in the IPP. They do have a TFSA, so they'll continue to do that through their personal cash flow. And of course, corporately, in the amount of $252,000 per year. So over the next 5 years, they would add well over $1 million. It'll probably grow to an additional $1.5 million or more. And the plan itself is based on spending $150,000 per year in today's dollars. So in 5 years from now, that number is going to actually be closer to, say, 170 just because of inflation. And that has been factored into these calculations. So this client would have liquid assets of retirement of $5.5 million, which, as you'll see, easily exceeds their FIT number of $3.8 million. So I'm going to spend a moment to share with you some of the assumptions and the projections, just so you can get a better sense of how we come to these conclusions. There are a number of assumptions that I alluded to before. For example, in the top here, we have inflation, which we've assumed at 2.5%. To the right of that, we've assumed different rates of return. In this example, we've made the simplifying assumption that the portfolio earns 5% across the board, as I alluded to earlier. And on the bottom, we have the client's pensions and retirement date. So CPP starting at 65 for each of them, and OAS. Now you'll notice the CPP percentage is not 100% for these two clients. It's actually 62%. And that's because they stopped working at age 55, and therefore they do not contribute the maximum number of years into CPP. And you know, that's fine in itself. We just simply plan around it. But they will be eligible for OAS at age 65. This is a projection of the client's net worth, specifically their investment assets, to see how their portfolio grows over time. So let's focus on what's happening here in the first 5 years. As you can see, their portfolio continues to grow, not just through market returns, but also because they're adding about $250,000 a year through corporation and personal savings. The black bar is, it says real assets, but this is just simply our software. It's actually the practice itself and the dental building. And you can see at age 55, the black bar goes away. It's actually replaced with the orange bar, which is their non-registered portfolio. In this case, the client was able to sell shares, which means they received the proceeds personally, and it can be invested into their non-registered account. So their assets reach a peak of just about 5.5 million at age the year before 55. It goes down slightly because there's some tax on the sale of their shares, which is factored in. And then you can see over the course of their lifetimes, the light blue is their RSP or their RIF. You'll see that eventually it gets drawn, starts to get drawn down. We've got the non-registered portfolio, which continues to grow for a few years, but eventually we draw upon it. The TFSA is green. It expands over time because they're repositioning money from a taxable account into a tax-free account. And the last color here, the purple, is the corporate money. Remember, we set up an associate DPC or a second company, and through our tax planning, we are drawing some income from the corporation as the years go by. And these projections, as you can see, go all the way out to the age of the surviving spouse, age 90, in these assumptions. This slide illustrates how we calculate the FIT number. Really, if you recall, the FIT number is the amount of money that's required to sustain the client's income throughout their lifetimes. So in this scenario, that target number would have been 3.8 million. So we've illustrated what would happen if the client had less assets at retirement. You can see the black bar is still there, the sale of the practice and the real estate, but it would show how funds would be consumed and the client would have lived their lifestyle and indexed for inflation, right? So we're not cutting corners here, but it tells you the client's FIT number in this case is 3.8. And thankfully, they exceed it quite nicely. And of course, there's always the home if need be, but we don't like to use that in these projections. This slide is showing the sources of income. In the first 5 years, you can see it's an orange bar, which means employment. The year of the sale, you can see that there's a bunch of cash flow, right, that's received, the proceeds from the sale. There are two colors here. One is taxable and one is non-taxable. In this particular case, the non-taxable amount did not reach 1.8 million. And that's because of the way that the client's corporation had been structured before they came to see us. It wasn't optimal. However, we did work with the client's corporate accountant to get it restructured before the sale so that we could get both spouses to optimize their tax-free portions as best possible in advance of the sale. And then for the remainder of the slide, you see the different sources of income. There's a new color that comes into it at age 65, which is CPP and OAS. The other thing to note is the dotted line, which is the client's tax, and it remains very steady throughout their lifetimes, which shows that that's really the optimal tax planning. The only exception is the spike, which happens at age 55, and it's about 150,000. So to review the first case study, there are a number of things that we touched on in order to create a comprehensive financial plan. We looked at the structure of the corporation in order to utilize the lifetime capital gains exemption. We looked at the financial statements, not only to compare the practice to its peer benchmarks, but we also looked for areas of improvement to improve the cash flow, allowing more savings each year, and ultimately to improve the value of the practice as well. We implemented an individual pension plan for accelerated savings. We saved within the IPP, TFSA, and corporate profits, and we were able to easily exceed the client's FIT number of 3.8 million. I think the key takeaway here is that a financial plan can provide that confidence and peace of mind for both clients and for ourselves to know that they're going to be okay. It also demonstrates the integration of the different pieces of the puzzle when it comes to developing a comprehensive financial plan. All right, so time for question number 2. And it is, IPP contributions are derived from salary, dividends, salary and dividends, or none of the above. Carla, do we have any Jeopardy music for the background?
I will make a note and include that for our next webinar.
Okay, hopefully people are okay with this question. How are we doing for results, Carla?
We have 28 results in. So I'll just give it another few more seconds here and then I'll share the results. Okay.
All right, yeah, so IPP is based only on salary, and that's just the way that RSPs are calculated as well. The two plans mimic each other in that respect, but the great advantage for an IPP is the ability to save more along the way and help purify the company. All right. It is time for case study number 2. Taking a little bit different approach with this one. It's a scenario where we were dealing with a widow, a recently retired teacher, in fact. Her spouse was a dentist who passed away about 5 years prior. So what we were focused on was making sure that this widow, this client, was in a suitable or comfortable financial position. And for other background, they had 3 children as well. So our discussion did include some estate planning. This net worth situation is pretty straightforward. At this point, there was a principal residence, a home, and then savings. The RIF, pretty substantial, simply because they'd had a lifetime of saving, and now both plans had been combined together. Same with the TFSA, and they had a non-registered account. So in total, the net worth was 2.85 million. This client's sources of income currently included Canada Pension Plan, but OAS had been deferred because as a part-time teacher, was still working, had other sources of income, and was concerned about the OAS clawback. So the advice had been to defer OAS for the time being to maximize the benefit. But in addition, was receiving the annual minimum from the RIF, which is about 75,000, and the pension. So total income was 122,000 less the tax. Cash flow after tax was 86,000, which, as you'll see, was more than enough to meet the lifestyle needs. So by now we're familiar with this, right? The cost to maintain the home was about $75,000 between home expenses, household, automobiles, and there were no insurance in this case, but had lifestyle expenses. So if you add it up, there was about $47,000 a year towards fixed household expenses, home and auto, and the remaining lifestyle was about $27,000 per year. So compared to our last example, this is certainly a much more modest lifestyle, but we wanted to make sure that they were going to feel comfortable nonetheless. In this scenario, we determined that, of course, we see that the client had liquid assets currently of 1.95 million, and they also easily exceed their FIT number of $750,000, which is a good news story. So again, we'll go through the assumptions, very similar, 2.5% inflation, 5% portfolio return. Client was receiving CPP, OAS was deferred till 70. You'll notice CPP also was not quite 100%. And just as a side note, most people do not actually get the maximum CPP because it takes a lifetime of contributions. Currently, it takes about 39 years of contributions in order to maximize. There might be some exceptions for child rearing years, but yeah, it takes an awful lot of 39 years under the current rules in order to get the maximum CPP. So let's take a look at this client's growth of their investments over time. As you can see, the portfolio starts just under $2 million, and thankfully it continues to grow. The blue is the non-registered account, pardon me, the registered account or the RIF. You can see that over time it continues to be drawn down. It gets smaller. In the meantime, they have more income than they need, so any of that excess income just gets reinvested in the non-registered account, which is why the orange bar continues to grow. And the same with the TFSA. We maximize those contributions over the lifetime. In terms of the FIT number, as you can see here, it was 0.75 million. If the client had far less assets, then this is what the picture would look like. You can see that the RIF would be drawn down substantially. There would be a period of time where there was some excess income at the beginning, which is why the TFSA goes up, but ultimately all resources would be consumed with the exception of the home if it was needed later. But thankfully the client had far more than this target. This is the client's sources of income now. The orange at the top is the teacher pension. You can see that it goes up with inflation. The RIF withdrawals, also just the nature of the way RIF withdrawals go. You can see here for the first few years, it stayed pretty steady. And then the withdrawals increase over time. That is the nature of RIF withdrawals. If it's based on the percentage and the current age. At this age, it's around 5% withdrawal, which is why we can keep the withdrawals steady. But the withdrawal rate increases to 7, 8, 10%. So it's intended to encroach on capital over time. But the dollar amount, the income that we receive generally goes up. The blue bar in the bottom is the CPP, and that's, as I said earlier, that's guaranteed. It goes up by inflation. But the interesting part of this discussion actually is the OAS. This client did not receive their full OAS entitlement simply because of the clawback. Now, in spite of deferring and waiting until 70 to get more, they were just in a very fortunate position to have more income than they clearly exceeded $80,000. And so a lot of it was clawed back. This actually became the focus of our discussion with the client, whether there were any ways to minimize the clawback. Strategies that we considered were was it better to continue to minimize the RIF withdrawals, try to keep the income as low as possible and capture what we could from OAS. The other extreme was to accelerate RIF withdrawals and see if it was beneficial over the rest of their lifetime. So I'm going to throw a table up here on the screen. We ran a number of scenarios to see what would be most beneficial. So let me just walk you through this table. Here on the left, we have annual spending, $75,000. I think we agree that's what the client needed for their income. And so that's what we were focusing on with the retirement plan. But the second column, RIF income, we were looking at ways to either keep it the same at $75,000 a year or accelerate it. Did it make sense to take a little bit faster? Or in scenario six, we withdrew 100% of the RIF all at one time. So if you look at the next couple columns, it shows that the OAS clawback was the highest, or you might say the worst result by status quo and keeping the RIF withdrawals at a minimum. And it was best with scenario 6 if we drew all the money out of the RIF, paid all the tax up front, and put ourselves into a lower bracket for the rest of our lifetimes. But you know what we discovered? If you look all the way to the end, the total estate was greatest by drawing the minimum RIF and forfeiting the OAS throughout those years. And it was the least in the final scenario, even though it would have resulted in the greatest recovery of OAS, it would have resulted in the lowest estate value. And that's simply because that one-time withdrawal, that tax hit up front is just so great that the assets remaining after the tax are not big enough to continue to grow and overcome the tax hit up front. So it really changed the course of the discussion and showed that tax planning was really, really important, and the complexity of these plans, because there's so many moving parts. We have tiered tax systems, and without this kind of software, it would be very difficult to do this reliably. So that highlights some of the things that we just talked about, but it did change the focus of our discussion to how to maximize the estate for the 3 children. And not surprisingly, life insurance is a great tool to be able to do that. So in fact, what we did with this client is we did illustrate how life insurance could be helpful. So now for some of the features about life insurance, in case you're not familiar, is that, of course, life insurance provides the liquidity when needed to help offset the tax payable by the estate. But the key is that the insurance proceeds are received tax-free. So in this case, we illustrated an insurance product from Manulife. It's a whole life program. And the premium is set at $250,000 a year. And I believe the initial death benefit was around $500,000. But of course, that would grow over time as premiums continue to be added. So what we did was we expanded the illustration here and ran some more scenarios. And again, on the left, what we did was we said, okay, well now instead of $75,000 a year, your spending is $100,000 a year because we need to allocate more for the insurance. But we're going to look at the same strategies to accelerate the RIF or not, and look at the clawback on OAS. And then over at the final column here, we're showing the insurance value 20 years from now, right, had grown to almost 800,000. And you can see that scenario 7, which includes the minimum RIF withdrawals, with the addition of the insurance, provided an even greater estate value. And I don't think that's a great surprise. Life insurance just has that unique trait of being able to enhance and accelerate the value of an estate. And we even incorporated it into the retirement projections and made sure that all the tax elements were accounted for. So as you can see, as I said earlier, tax planning is really critical to enhancing retirement income. And as you can see in this example, that life insurance was effective at enhancing the future estate value as well. Okay, time for our third and last question. Some features of life insurance are: it enhances the estate value, provides liquidity to offset tax payable by the estate, the insurance proceeds are tax-free, or all of the above. Carla, are you able to put up the question?
Sorry, it's giving me a little bit of a glitch here. I apologize, Chris, this is not, it's not launching. It says that there's a poll already started, which I'm not sure.
Okay, okay.
I apologize.
Not a problem. Then I will share the answer, and the answer, of course, is D, all of the above. It doesn't enhance the estate value. It does provide liquidity, and the proceeds are tax-free. Okay, the final segment that I'll speak about briefly is on estate planning, because it really is an integral part of a comprehensive plan as well. You know, the point of estate planning is to ensure that your wishes are satisfied. But it's more than that. It can offer ways to reduce tax and probate fees, and certainly ease the administration of the estate for loved ones. I must admit, most of the clients we meet with do have wills and powers of attorney in place, thankfully, but it's so important because without them, it just causes so much difficulty and troubles for the family at a difficult time. One of the common planning techniques, at least for Ontario, is the use of secondary wills. And it's so helpful to be able to reduce probate fees, which currently are 1.5% of the value of the assets in the estate. So secondary wills are helpful for those who have shares in a private corporation, like the Dentistry Professional Corp or a holding company, because we can use a secondary will to avoid probate. It's also important to review the successor annuitants on your plans and beneficiaries. So things like RIFs and tax-free savings accounts and life insurance, because we can avoid the estate and avoid the probate fees in the process. And it just illustrates the importance of integrating estate planning into a financial plan. Right? As we said earlier, it's not about it's about the integration of all these pieces that's so important. And I can tell you from experience of the team in our office, we've held many meetings between the client and an estate lawyer, for example, where we're part of those discussions, we're in the meeting itself, we're able to bridge the gap, we're able to provide information to both sides and really simplify and enhance that discussion, possibly reduce the time and the fees, you know, because of billing the way that the lawyers work. And it's very helpful. I think everyone finds it very helpful to have the advisor in the meeting with the clients. So estate planning, it's a key component of the financial planning that we do. And we're getting close to the end of the presentation here. So I just wanted to wrap it up. I hope that by now we've been able to demonstrate how TMFD helps our clients to bring all the pieces together, to integrate their affairs. And there are services that we offer in-house, and what we can't, we bring the other professionals to the table to simplify the lives of dentists. So in conclusion, hopefully our presentation, we've been able to demonstrate that the FIT number is the savings target needed to achieve financial independence and a secure retirement. But it's also important to note that each situation is unique and requires a customized analysis. At the end of the day, a customized financial plan provides the confidence and the decision-making for your financial future. It can allow you to take your foot off the pedal and work at your pace, or to stop work entirely and pursue other interests. So it's time to take action. If you'd like help in developing a personalized financial plan and determine your unique FIT number, please contact us. We have a team of experienced advisors who would be pleased to get to know your situation and put you on the path to financial independence. And with that, I thank you very much, and I'll turn it back to Gary for any questions.
Chris, there is a question that I'll read to you. My accountant says that a person can request the government to not give them OAS, and this will reduce their taxes, provided that the dentist knows that their income will always be above $80,000. Is that true?
Well, you can contact the government and ask to have 100% withholding tax on your OAS. If you're in a fortunate enough situation that your income's high and you may never qualify for it, then I suppose it's a good situation to be in. But in my mind, I think it always makes sense to apply for OAS, because there could be changes, unforeseen changes in your circumstances where you might actually qualify 1 year. It's reevaluated year after year. So there might be changes in income 1 year, and if you don't apply, you'll never get. And But you certainly can request 100% withholding. I would certainly apply. And if it turns out that you do happen to qualify 1 year and you've already requested 100% withholding, it's okay. It's a calculation done on your tax return, and you will get back what you're entitled to receive.
And Chris, what I got from your presentation as well is that you and your peers do not go by rules of thumb. Well, everyone knows you should do this, everyone knows you should do that. Well, you take the time and actually do the analysis of all the options for the clients and come up with what's right for them. And what might be right for one person might be different for another person, depending on all sorts of situations and cash flows and so on that you talked about.
Absolutely. I mean, there are so many factors. There is software out there where you can plug in a number and get a projection, but there's no way that it's customized. We deal with situations where there's one spouse, two, retiring early, retiring late, working part-time, different corporate structures, different family needs. There's all kinds of scenarios. It's just impossible to simplify it greatly. That's why we have good software, and we can program it and customize it and capture all those unique features of each person's situation.
And the expertise to use it as well and to apply it in addition to just the software.
Correct, yeah.
Chris, there's another question here. Can you provide an example of an estate tax amount if you die and you are worth $25 million? How much would your children be expected to pay in tax?
Well, it depends, and it really does, because the tax depends on a variety of things. Most of the time, there's money still left in an RSP or a RIF, which is money that's not been taxed yet. And in that situation, the tax rate could be as much as 50% or 53%. I mean, it's the top tax rate. Aside from that, it comes down to any other investments that have not been taxed yet, typically capital gains on a non-registered portfolio, or it could be other recreational property that you may have. It could also be money that's left inside of an investment holding company. So there's different tax rates depending on the situation. So I wouldn't say it would be as much as half of 25 million. That would be just too high. But in a situation like that, I don't know, it could be a third. It could even be much less than that. It just depends on the makeup of the situation. So it's so hard to tell. You'd actually have to sit down with an advisor and look at each asset that you have: home, properties, other real estate, holding company, RIF, other investments, and go line by line and figure out what the impact is on each one of them.
And Chris, what advice would you have in terms of perhaps planning that out prior to death as well, versus waiting until after death?
True enough, it's too late when someone passes away. So there are a few things that you look at. We talked earlier about corporate structure, making sure you can maximize lifetime capital gains. That should be done as soon as possible. You can look at the beneficiary designations on certain plans like RSP, RIF, TFSA, life insurance, pensions as well. Pensions allow for beneficiary designation. So there are a number of things that you can do in advance. At the same time, some things may be limited because things like RSPs and corporate investments are deferral tools. They will be taxed at one point. So one of the key messages in this discussion tonight was finding a way to draw down on your savings in a manner that smooths your income and smooths the tax bill over your lifetime.
Thank you, Chris. I don't see that we have any other questions. So just before Carla talks about the CE credits, which we know everyone wants, I just want to give a plug for the next two sessions that we will be having. But again, thanks, Chris, for the fantastic knowledge sharing and so on, and showing just what it is that you and others do. So thank you again for that. Our next webinar in the TMFD Academy will be on October 20th, and that's a Wednesday. We're doing these different nights on purpose. So we know some may have commitments on a particular night every week, so we're spreading them across the week. The next one is Wednesday, October the 20th. And I see that our speaker is on watching us this evening. And so I hope I am okay with the pronunciation here. It will be Provisionalization in Aesthetic Dentistry by Dr. Tony Mancuso will present. And so Tony, I don't think I would say anything more than the title on that one myself. I wouldn't be qualified to, and I wouldn't be qualified to ask any questions at the end either. But we know, Tony, that that you are enthusiastic about what you do. So for those who don't know Dr. Tony Mancuso, he is enthusiastic, and I know it will be another great presentation. And then the fourth in the series for the fall will be on Thursday, the 18th of November. And Steve Farinato from TMFD, as Chris mentioned, will speak about preparing to sell your dental practice. So that will also be one of interest to many, many dentists. And then that's not the end. Our 2022 dates will be available soon on our website. And so we look forward to hosting more of these into next year. So with that, I'm just going to turn it over to Carla to talk about the CE credits, and we'll say good night and thank you for joining us.
Thank you, Gary. So yes, the CE credits, a certificate will be emailed out to you individually to the email that you registered with. So we will, of course, cross-reference and make sure that we have the correct information and details on file for you. And you will receive an email with your certificate no later than Friday, October 29th. We'll get those out to you by the 29th of October. Okay. So thank you again, everyone, for joining us this evening. Thank you again, Chris, for the wonderful presentation, and Gary for hosting this evening. And good night, everyone. Enjoy your evening.